Hey guys, today I want to talk about something that's super simple, but most of us don't really know how it works. So, we're going to talk about auto loans. I remember when I went to go buy my first car, or a couple of the unsuccessful times that I thought, oh, well, I'll buy a new car, and then, I didn't end up getting it. But the buying process was pretty much the same every time. Every time I would go into a car dealership and I had like a monthly dollar amount in mind, and that was a set amount that I wasn't going to pay more than, and that was my negotiating tool. This is my monthly payment. What I didn't realize at the time was how the payments are set up. So I figured it out, obviously, and I actually think that it is a really good tool for you to have so that you know it's a really simple concept. It's just something that nobody ever teaches us. So I am going to explain it to you and draw you what could potentially be a really ugly picture of basically how the payments are broken down. I use this example in my classes every month, and I think that it works. The feedback is pretty good, so hopefully it works for you guys too. Basically, you have two different people. I've asked my classes a lot of times, well, what is the highest interest rate you've heard of? And I've heard some outrageous numbers, including 21%. So that's what we'll use here. So we're going to have two different people buy the same $10,000 car or a $10,000 car, and they're both going to be getting a $250 a month payment. One guy is going to be paying 21% interest, and the other guy is going to be paying 3% interest. So when you look at the loan, the actual interest rate is based off of the total amount of the loan, okay? So if they owe $10,000 at 21%, he's going to be paying $210 in interest and only $40 towards principal, where the guy who's paying 3% interest on his $10,000 car is going to pay $30 in interest and $220 on principal. So the interest rate that you have on your car is really going to have a compound effect on your entire loan, the length of the loan, and all of that stuff. So whenever I would go to buy a car and I thought that my haggling thing was the monthly payment, they would just extend out the monthly payment so that they could give me what I said I wanted. I remember one of the first times when I didn't have all of my education and everything, I was told, oh yeah, you can have this $250 payment and it's going to be over like 7 years. I don't remember the exact details, but I was like, what? Give me a calculator. So I put it in the calculator and it was like so much more than the car was originally supposed to cost, and that's when I was really confused about the whole process and decided to sort of put it on hold until I understood a little bit more about it. So anyways, I think that this is very important information to arm yourself with when you do go buy a car. The interest rate that you get on a car is really based off of your credit score. There are some financial planners out there that believe that you shouldn't buy anything on credit. You should get everything in cash. I just don't prescribe to that. I would prefer to buy everything in cash for obvious reasons. However, I do believe that you need to have a good credit score, and your credit score is not an evaluation of how good you are with money. It's an evaluation of how good you are at being in debt. So if you think about it that way, we all do need to have like a little bit of debt just to supplement our credit scores, basically. So other people that are going to look at your credit score is a landlord, government agencies, insurance companies, and potential employers. So it's not just about being able to get good credit. So I honestly believe that we do need to do some things to make sure that our credit is okay, and I will make sure to make another video about that. I know so much about credit, I could go on and on and on about it. The basic point here for today is that the higher your credit score, the lower the interest rate. So if credit is something that you need to work on right now, maybe it makes sense to get a less expensive car so that you're not paying that compound interest on a more expensive car. Or if you have the cash to buy kind of like a beater right now, do that and then wait until you've supplemented your credit score enough to be able to get into a car loan that's not going to cost you thousands of dollars $100, okay? Another thing is that when you do have a really high interest rate on your car, it's more likely that you'll be upside down in that car. So if something happens and you need to get rid of it, it's going to be a lot harder for you to get rid of because you're going to be upside down. So I hope all of that makes sense to you guys, and please leave me questions if you have any. I love to get back to you. I think this topic's pretty simple, but maybe that's just because I've been talking about it for a lot of years now. So please let me know if I need to go into further detail or give you more information. Any other topics you want me to address, please let me know. I will be happy to go over that. See you later.